All right, episode 2 of Mastering the Market Structure. And in this episode, I'm going to talk about major and minor structure. Yes, major and minor structure. Let's get into it. All right, now, major and minor structure, these are very important. Uh, a very important topic in terms of market structure. Now, major and minor structure, before we talk about major and minor structure, we need to understand the thing called swing point. Okay, this is the first thing now we need to cover. Now, swing point is simply the most highest, okay, the most highest or the lowest point of the structure Now, excuse my handwriting here. Okay, good. Now, the most highest point and the most lowest point of a structure is what we call a swing point. Now, the highest point we'll call them swing high, and the lowest point we'll call them a swing low. Okay, so these are the swing point. Now, how can you spot them? You know, the market can produce a lot of structure. For example, market can go like this, and then goes down like that, and then comes up again like that, and then comes down again like that, consuming all liquidities. And okay, you can find a situation like this. Now, the most highest and the most lowest of a structure, when we are talking about the structure, okay, mind you that when we have a breakout structure right here, okay, that point where we have a high is what we call a what? A validation point. And here, this point here is called the invalidation point. Now, when the market breaks there, this is a structure from that high validation to that invalidation. That is what we call a structure. Okay, that is a structure. Okay, a formation, you can say like that. Okay, now the swing point is the swing point consists with multiple structure, creating a highest point and the lowest point. For example, in this point here, we can say the swing point here, we have this swing point here, and this swing low here, and this swing high, and this is swing low. So these are the swing point. Why? Because this is the most highest point of this structure here, and this is the lowest point of this structure here. This is the highest point of this structure here, and this is the lowest point of this structure. Okay, so this is the swing high, the swing high, and this is a swing low. This is a swing low, and this is a swing high. Okay, now that is swing point. That is swing point. Now, going back to our topic, major and minor structure. Now, when we say major, okay, a major structure, we are talking about the whole structure, okay, the whole structure. When we have a market creating swing lows and swing high, swing point like this, okay, so this here is the major structure. The major structure is the whole structure, including the swing point, But when we talk about minor structure, these are the smallest structure inside the major structure. For example, this is the major, okay? This is the major, and inside here we have small structure. We have this break of structure here. This was the minor structure. This was a minor structure. This was a minor structure, a minor structure, a minor structure. So inside this major structure, we find small minor structure inside the major structure. Okay, so the minor structure is the smallest structure inside the major, and the major structure is the whole structure in terms of swing highs and swing low. Okay, in terms of swing high and swing low. Now you have to note here. You have to note here. When we are trying to look the major and minor structure, we don't change time frame. For example, if you are in a 1 hour time frame, you need to observe major and minor structure on that same time frame. You cannot mark, for example, this is the 1 hour time frame structure, and then you go to the lower time frame to look for minor structure inside there. Yes, it is correct, but in terms of this, the theory of behind trading this minor and major, you need to look this to observe these minor and major structures in a same time frame that you are in at that moment. For example, if I observe this is maybe the 4 hour time frame, okay, I need to see this is the minor, the major structure, and inside here I need to find the small structure at that time frame, at that same time frame, the 4 hour, and then sorry, and then you can be able to trade the major and minor structure. Now, there is a law. There is a law. Okay. Now, this law states like this. Okay, we have major here, and minor here. Now, listen closely here. This is very important. This is very, very, very important. Okay. Now, when we find a major break, if we find a major break, when the major structure is, we have a break of structure in a major structure, then you are not allowed to trade the minor structure. You're not allowed to trade a minor structure. And if the major structure, the market did not break a major structure, then you are allowed to trade minor structure. Now, this is very heavy. Okay, I need you to listen here closely. Okay, what do I mean by this law here? What do I mean by this law here? All right, let's draw our structure here. For example, we find the market creating a major structure right here and minor structure like that. So, for example, you find yourself at this point here. Okay, this is a minor structure and this is a major structure. Okay, this is a major structure. We haven't break a major structure. So if we haven't break a major structure, we are allowed to trade this small structure, meaning we will find entries inside that structure and trade that structure. If we break that, we need to trade that minor structure and so on and so on. But when we break that structure, we're not allowed to trade this minor structure, because if the major structure is broken, then the price needs to consume all the liquidities of the whole structure. So you have to consider the whole structure and not just a minor. I think You get the point here, okay? I think you got the point here. Now, let's go to the chart and try to illustrate this concept a little deeper. All right, now we're going to use this chart from GBP JPY, and currently here we're in 1 hour time frame. Okay, we're in 1 hour time frame. Now, look closely here. First of all, we talked about the swing point, right? We talked about the swing point. Now, the proper way to mark swing points, you're gonna have to squeeze a chart like here. We can use this current market structure right now. Here, we can squeeze the chart here, and you can see the market created. Let me try to find something here. Okay, so you can see the market created this swing point here. This is swing high, this is swing low, and then we have a swing high, a swing low. This here tried to break and failed, so we have a swing high right there, and the market is trying to make a swing low right there. So now those are the swing point, okay? And inside those swing point, we can find small structures. So these are the major structure. We have a break structure here. That was the major structure. So that concept, the law that I taught you, that when we find a break structure of a major structure, we are not allowed to trade this minor structure. Why? Because the price will try to consume all the details first and then goes to the direction. Okay, so that's why we can find this minor structure failed to contain this price. This minor structure also failed to hold this price. Then the price came back here to this level here and take that entry right there. So if you placed orders here, you could have been stopped. Why? Because price breaked the major structure. All right, price breaked the major. You get a point, right? Now you can see. So price here failed to break here, so we cannot consider this as the break of structure. So now we can consider this as our minor structure. Then that's why price came here to this minor structure and hold this price, okay? And hold this price, and then the price goes and break that structure there. So we can see when you consider this structure as major and minor, you can be able to identify areas to consider just by looking this structure. Okay, just by looking this structure. Now, so these are the major and minor structure. And the last thing I want to consider here, is how to spot a real trend. Okay, how to spot a real trend. Now the secret here is to use the higher time frames. Now we're going to talk about the higher time frames in the next episodes, but in case of this episode here, the higher time frame can be defined in many ways actually. So other people use daily time frame as the higher time frame, other people use the 4 hour as the higher time frame, or some people use weekly as the higher time frame. But the higher time frame to consider here is starting from the 4 hour time frame, going to the higher time frame, maybe the monthly or whatever. So from the 4-hour to the monthly time frame, in these time frames, you can be able to spot the real trend. Now, why am I saying the real trend? Okay, you can find maybe daily time frame providing us a break of structure right here. Okay, but when you go to maybe 30 minutes or 1 hour, you can find that break of structure created maybe an uptrend like this, Okay, so in the 1 hour you can find it is uptrend, but in the daily you can find it is downtrend. Okay, you're going to be confused here, but the real trend is from the higher time frame, and the higher time frame is from the 4-hour to the monthly time frame. I'm gonna give you the reasons why I start from 4-hour to monthly as higher time frame, and instead of maybe 1 hour. No. It is from 4-hour. 1 hour, I don't use 1 hour because 1 hour sometimes can be used as a scalping time frame. Okay, so I'm gonna give you the reasons when we reach that episode, when we are going to talk about some time frame. Now, the real trend, you can define the real trend from the 4-hour to monthly. Okay, so going back to the chart, okay, when we plot the, for example, maybe let's use daily time frame. Okay, let's use daily time frame. Now you can see here in the daily time frame, it is clear it is an uptrend. Why? Because we can find a break of structure right there, creating the series of high highs and high lows. You can see a break of structure, high highs and high lows, another break of structure right there, and then the market is trying to break another break of structure right there. So you can clearly say we are in the uptrend. Okay, we're in the uptrend. Okay, but when we go to the lower time frame, maybe we use 15 minutes as to identify the trend. You can see the currently here we're in a downtrend. Okay, we're in a downtrend. Look, that is a break of structure in a downtrend. Okay, another break of structure. You can see the market is trying to come and consume all the liquidities back here. So the real trend is defined from the higher time frame. So that is how we do it. So in this episode, we were able to differentiate between major and minor structure, and talking a little bit on swing point, and then how to spot a real trend. So thank you very much. See you on the next episode.